Thanks for tuning in. I want to do a short video covering a topic that I've covered previously, but it keeps coming up in interesting ways. So I want to provide another example, and what I'm talking about here, or about to, is that a put spread equals a call spread, and this relates to synthetics and getting in and out of positions, especially in short-term trades such as 0, 1 day, 2 day DTE type trades in the SPOOs. I'm not going to use SPX in this example because the market is currently closed. Let's see, it's 10 minutes of 8 p.m. Monday the 15th of Jan PT time, by the way. So it's not quite 8 p.m. on the Pacific Coast. SPOOs, the SPX is closed. However, the emini's open and it looks like it down 16 handles. Interesting, right at 48, which is where the SPOOs were hitting last week. Hit last week a couple times, SPX. Anyway, let me get to a bond example here, and I'm going to go out to the 11 DTE, and let's look at selling a put spread, which when people want to take in a credit, they typically look to sell some sort of vertical, and in this case I'm going to use the puts. So we're going to sell, by the way, the futures is trading at 122.08. All right, down 20 ticks, which is interesting. All right, I'll get to that later. But anyway, I'm going to sell the strike at 120, and the prices right now don't matter too much, but it's printing 18 down here. All right, so if I just sold this put, I would collect 18 ticks, 18 bond ticks in the options, and each tick here is 15.62. So now I will go ahead and buy the 119, and looking at the difference, ask to ask, it's roughly 8, but it's currently printing 9. All right, so 9 ticks, 9 times 1.5, 14, 14-ish, 14 and a half. So we're going to get 9 times 15.62. Our max profit here would be 140.63. That's the credit that we're selling. 9 ticks times 15.62. And then the max loss would be a handle from 120 to 119 minus the 9 ticks. And note that because bonds, a handle in the bonds is worth $1,000, the bond options use 64ths, and 64 times 15.62 is going to give you the 1,000. But anyway, note here that the max profit at this point is the credit we received of 140.63, and the max loss would be the difference in the width of the strikes, which is 1, times 1,000. So it would be 1,000 minus the credit received of 140.63. So our max loss is 859.38. All right. Now, I believe that everyone is aware that when you sell this put credit spread, you are collecting a credit. In this case, it would be hypothetically 9 ticks. And I'll go to the analysis tab so we can see a quick visual of this put credit spread. So this is a bullish put spread that I'm teeing up here, or queuing up. And here we go. This is what it looks like. Again, our max profit, and then our losses to the downside if we don't do anything, and bonds close at expiration below this area, we're going to lose possibly $859. Now let's get into the interesting part. And people say, well, if you buy a bullish call spread here, you have time value working against you. And I'm going to show you why that's not true, or time decay working against you is not true. So now notice what I did here is I'm buying the 119 call and I'm selling the 120 call. our max profit is exactly the same as it was selling the put spread, 140.63, 140 bucks and 63 cents. And our max loss is exactly the same as when we were selling the put spread. Now, in this bullish call spread, we're paying 55 ticks. And remember that a handle in the bonds is 64 ticks. All right, so this 9-tick difference between 64 and 65 makes our max profit, and our max loss would be if we didn't do anything, the bonds went lower and kept going below the relevant strikes, we would lose 55 ticks, and that would be $859.38. Now here is something to think about. We're buying a call spread. It's in the money. The March bonds currently trading at in the 122 handle, 8 bid at 9. Wide enough, 204 by 124. Volume so far is almost 70K. But people are under the assumption that if they buy this call spread, they have time decay working against them. All right. Now here's one thing to note right away. If we go to the extrinsic section here, notice it has positive 141. I'm going to queue up the put spread again. We're selling this put spread, which is bullish. The extrinsic is 141. So that is what this setup is looking to collect in time premium, time decay. So if we're buying this call spread, why is this the same as selling a put spread? We're buying the call spread and we're benefiting from time decay, which is the exact opposite of what a lot of people think when you buy a call spread. This is a debit. People have all kinds of things that they say about debit. Doing a debit spread is bad, death before debit, blah, blah, blah. But let's take a closer look. All right, let's start with the 119 call that we're purchasing. Let's just say we pay 3 handles and 28 ticks. So 119, we go 3 handles forward. We're looking at the intrinsic value of this. We have 3 handles and let's just say 9 bond ticks in intrinsic value. And above that, let's say we paid 328. Now that is time premium that this particular part of the spread is buying. So it's paying for roughly 19 ticks in premium, in time decay. And that, yeah, would be working against you if you bought it. But there's another component to this trade. We're also selling the 120 call for 2 handles and 37 ticks. So 120 plus 2 handles would take us to the 122 handle. And we're also selling another 37 ticks here. 37 minus 9 is going to be 28 ticks in premium that this brings in. All right? And the 28 minus the 19, this is the futures price on the ask, and I'm subtracting this premium from that futures price. So notice our net premium is positive, and it's the same premium that we're bringing in, 141, an extrinsic value, from selling the put spread. So what we effectively did by buying this call spread for a debit, mind you, of 55 ticks, brings in the exact amount of premium as selling the put spread. And why? Think about it. Think about where these strikes are, 119 and 120, relative to the current price of bonds. You're trading 2 or 3 handles higher. All right? So this strike at 120, which we're selling, is bringing in more premium than we're buying the extrinsic values. We're selling more extrinsic value than we're paying when we buy the 119 call. And that is why this extrinsic value, this time decay, even though this trade is set up as a debit, which is the same thing as selling the put spread, this call spread that we're buying brings in premium. So we have time decay working in our favor. Exactly the same as selling the put credit spread. So there's something interesting to think about. All right, thank you for tuning in. I'll catch you guys next time.